Most homeowners assume their insurance policy will renew automatically every year. You pay your premiums, you stay out of trouble, the policy continues. But there's a process happening on the other side of that renewal that most homeowners never see. And it can end with a letter in your mailbox that says your insurance company will not be renewing your policy. No claim, no complaint, no warning. I've worked inside insurance underwriting for nearly a decade. I've been part of the process that generates those letters. By the end of this video, you'll know exactly what triggers a non-renewal, what goes on the review list, and what you can do about it before it happens to you. Stay with me. Let me explain how most people find out their insurer isn't renewing them. They open an envelope, usually 60 to 90 days before their renewal date, and there's a letter. It says the company has decided not to offer renewal terms. It gives a reason. Sometimes it's vague, sometimes it's specific. And almost always, the homeowner is surprised. Because nothing obvious happened. No major claim, no late payments, no calls to the broker. What they don't realize is that the decision wasn't made because of one thing. It was made because of a combination of factors that were accumulating in their file quietly for months or years. Insurance companies don't drop policyholders impulsively. They do it through a systematic underwriting review process. And once you understand what that process looks at, you can see the warning signs long before the letter arrives. Insurance is a risk pooling business. Every policyholder in a company's book contributes premiums. Those premiums collectively pay for claims. When an individual property starts to look like it will cost more in claims than it generates in premiums, the underwriting economics break down. The insurer has two options: raise the premium high enough to offset the risk, or decline to renew the policy. In competitive markets, raising premiums dramatically can drive away the customer anyway, so in many cases, non-renewal is the outcome. This is not personal, it is actuarial. The question is, what makes a property look like a bad risk? Before I walk you through the 4 triggers, there's something worth understanding about how the review process works in practice. Most policyholders interact with their insurer twice a year, once when they pay their premium, once if they file a claim. That's it. The underwriter, on the other hand, never stops looking at the data. Every time a claim is filed in your postal code, it updates the risk model. Every time weather events change the expected loss ratio in your region, it changes the pricing framework. Every time a property inspector submits a report, it enters the file. The homeowner's experience of insurance is transactional. The insurer's experience of your property is continuous. That asymmetry is exactly why non-renewals catch people off guard. The insurer has been watching a file accumulate risk signals for months or years. The homeowner opened a single letter. Understanding that dynamic changes how you think about every item on this list. Not every policy gets reviewed in detail every year. Most renewals are automated. The file gets flagged for human underwriting review when certain conditions are present. Yet the first condition is claims history. 2 or more claims in a 6-year period almost always triggers a review. The type of claim matters. Water damage and liability claims carry the most weight, but volume matters too. A pattern of claims, regardless of individual size, signals a property or a homeowner who is statistically more likely to claim again. The second condition is property condition. Insurers conduct inspection programs. Not every property gets inspected every year, but when an inspection happens or when information arrives through other channels like aerial imagery or municipal records, condition issues get flagged. The most common condition triggers: roof age over 20 years, knob and tube wiring, galvanized steel plumbing, oil tanks on the property, and deferred maintenance that creates visible hazard risk. These are not arbitrary. They are the physical characteristics that appear repeatedly in claims data. The third condition is external risk factors. A property in a postal code with significantly elevated claims frequency due to weather events, theft, or water table changes can trigger review even when the individual property has a clean record. The insurer's exposure to that geographic area as a whole affects individual decisions. The fourth condition is underwriting appetite changes. Sometimes an insurer decides to reduce or exit a market segment, high-value homes, older homes, specific regions, wood frame construction, coastal properties. When that happens, policies in the affected category come up for review at renewal, regardless of individual risk factors. This is the hardest category for homeowners to understand because it has nothing to do with anything they did. The insurer is making a portfolio decision. An entire category of homes gets repriced or non-renewed overnight. Now, here is the piece that most explainer videos miss entirely. These four conditions don't operate independently. They compound. A property with a 22-year-old roof is flagged. A property with a 22-year-old roof in a high claims postal code is flagged more urgently. A property with a 22-year-old roof, a claims history of 2 water damage incidents in 4 years, in a postal code with elevated weather risk. That property is not just flagged. It is a non-renewal candidate. The underwriting math doesn't add these factors, it multiplies them. Each additional risk signal narrows the range of outcomes the insurer is willing to accept. At some point, and the threshold is lower than most homeowners expect, the combination of factors produces a risk profile that simply doesn't fit the insurer's book at any price they're willing to offer. This is why the response strategy isn't to fix one thing and assume you're safe. The response strategy is to understand your full risk profile and work on as many factors simultaneously as you can. Which brings me to what actually happens when the file gets reviewed. When a file is flagged, an underwriter looks at the full picture. Claims history, property characteristics, inspection reports, geographic risk, policy tenure, payment history. They're asking one question: does this risk belong in our book at a price we can offer? If the answer is no, the file goes to a non-renewal workflow. A letter is generated. The required notice period, which varies by province, begins. Most high-standard insurers provide 60 to 90 days notice. The legal minimum in provinces like Ontario is 30 days. Check your Provincial Insurance Act for the statutory minimum in your area. The homeowner receives the letter, and at that point, they have a limited window to act. So, what do you do if you receive a non-renewal notice? Step 1. Don't panic and don't wait. You have 60 to 90 days depending on your province. That is enough time to find replacement coverage if you act immediately. It is not enough time if you wait 3 weeks before calling your broker. Call your broker the same week the letter arrives. Tell them you need replacement coverage secured before the non-renewal date. Step 2. Understand the reason. Ask your broker to get the specific reason from the insurer. If it's a condition issue, aging roof, old wiring, you may be able to address it and request reconsideration before the renewal date. Some insurers will reverse a non-renewal if the underlying condition is resolved. Not all will, but it's worth asking. Step 3. Document everything. If you've made improvements to the property, a new roof, updated electrical, replaced plumbing, have those documented and ready. A certificate from a licensed contractor is useful. Invoices work. Anything that demonstrates the condition issue has been addressed. Step 4. Go to market. Your broker should be placing you with a new insurer within the first 2 weeks. If they're not, contact other brokers. Non-renewals are not the end of your insurability, but the standard market may price you higher given the non-renewal on your record. In some cases, particularly with significant claims history or multiple non-renewals, you may end up in the non-standard or facility market. Coverage is still available. The premium will be higher. And how do you avoid getting to this point in the first place? The single most effective thing you can do is address property condition issues proactively before they appear in an inspection report. If your roof is more than 20 years old, the underwriting math is working against you at every renewal. Getting it replaced changes the risk profile immediately. If you have old wiring or plumbing, a licensed inspection and a quote for replacement goes a long way toward demonstrating you're an attentive homeowner. And if you're in a high claims postal code, you can't change the geography. But you can make sure everything else in your file is clean. There's one more thing worth mentioning, and it's something most brokers won't bring up unless you ask directly. Proactive communication with your insurer works. If you've replaced a roof in the last 2 years, call your broker and ask them to update the file. If you've had old wiring remediated, get the certificate to your broker and ask them to confirm it's been noted. Most policyholders assume the insurer already knows about improvements. They don't, unless you tell them. Property improvements don't automatically flow into an underwriting file. You have to push them in. And the difference between a file that shows a 22-year-old roof and a file that shows a roof replaced 2 years ago with a contractor certificate attached is not a minor difference. It can be the difference between a renewal and a non-renewal notice. It can be the difference between a standard rate and a 40% premium increase. Your file is not a passive document, it's a negotiating position. The homeowners who get the best outcomes treat it that way. That's the full picture. Non-renewals aren't random. They're the output of a systematic process that looks at claims history, property condition, geographic risk, and underwriting appetite. Most of the triggers are visible in advance, if you know what to look for. The homeowners who don't get surprised by a non-renewal letter are the ones who treat insurance like a relationship worth maintaining, not a bill they set on autopay and forget. If you found this useful, subscribe. I publish one of these every week. Everything I cover comes from nearly a decade of working inside the Canadian insurance industry. I've put a link in the description to compare home insurance rates from multiple Canadian providers. If you've received a non-renewal notice, or if you just want to know whether your current rate is competitive, that comparison takes about 3 minutes. And if you missed the last 2 videos, one on why premiums are increasing across Canada and one on when to file a claim, I've linked both at the end of this video. They give you the full picture of how underwriters actually think about your file. See you next week.